What's going on, everyone? It's Ty here. Happy Monday, November 7th. New York City, Virginia, beautiful weather, 70 degrees, almost borderline 80. Hey, that's November, all 4 seasons in a week. Global warming is crazy. Day before Election Day. I wanted to bring the topic of warrants versus options. I don't know if a lot of people hear about the term warrants, but I wanted to explain the difference between warrants and options. They're very similar, but of course, they have their differences. And I wanted to use the example of Berkshire Hathaway and Bank of America. Berkshire Hathaway, one of my favorite companies, of course, the Oracle of Omaha. You've heard of him, Warren Buffett. If you haven't heard of him, I would like to know what rock you're living under. But yeah, I want to use them as an example because in 2011, Berkshire Hathaway invested in a struggling Bank of America. They gave them $5 billion. They were issued some warrants, and it gave them priority on preferred stock, voting rights, and powers, and it gave them warrants at a 5% premium, 5% dividend. So I want to go a little deeper, dig a little deeper into what that means for Berkshire Hathaway, what that means for Bank of America. So of course, right now Berkshire Hathaway stands at a market cap of 633 billion. They just recently had a $2.6 billion loss during the quarter because of the market turmoil. But I will say, don't panic. I mean, the Oracle of Omaha, Warren Buffett, Berkshire Hathaway, he is so successful because he has a huge, talented team behind him. It's one of those things where he's so smart that he knows he's not the smartest person, so he hires talented people. I will say that although there has been turmoil in the market, they're Class A stock. There are two classes, Class A and Class B. We'll get into that as well. Their Class A dipped only about 4% when the S&P dipped about 20%. So of course, you still have some leeway there. There's some good hedges in place. I love the term that Ray Dalio uses. It's called the all-weather portfolio, all-weather fund. September, it was reported that they had a cash pile of $109 billion. Of course, that is huge because, I mean, you can make moves. It also has been reported because of that $109 billion, recently they've been buying back their stock. I think it was about a $1.5 billion buyback plan that they rolled out. So that's pretty good for Berkshire. And going back to those losses, $2.6 billion in third quarter losses, you have to remember Hurricane Ian. What does that come into play? So remember, Berkshire Hathaway owns Geico, which is an insurance firm. They also own other insurance companies. So the insurance arm alone reported a loss of $2.7 billion. And that's a combination of Hurricane Ian paying out those claims, paying out those losses, in addition to the rise of inflation. So of course, supplies, anything that they need in regards to repairing what needs to be repaired is more expensive. So that's going to cost them as well. What I love about them is they are some of the biggest shareholders for Bank of America, some big shareholders in Apple, and I believe their third largest holding is American Express. Some of my favorite companies. Three of my top favorite that they own: Geico, NetJets, and Extra Leasing. They lease and rent trailers for 18-wheelers, flatbeds, trucking industry. About 90,000 trailers and flatbeds that they lease out. So that's huge. NetJets is a fractional private jet company. They allow you to purchase fractional shares of a jet. So it's more like timeshare. So you're able to buy in to the fractional ownership of a jet, and you can use those hours on a yearly basis. So those are my three favorite companies that they hold, and at the same time, they do own stock, majority of stock in a lot of companies: so BNY Mellon, Citigroup, Wells Fargo, to name a few. But the most important thing about this here, I want to go into the difference between warrants and options, and how Bank of America and Berkshire Hathaway went into a partnership in 2011, where Bank of America issued warrants to Berkshire Hathaway, and Berkshire Hathaway invested $5 billion. At the time, Bank of America was struggling, so they needed this investment. Although it is public record that Warren Buffett was trying to call up Brian Moynihan, couldn't get in contact with him, finally got in contact with him, and Mr. Moynihan stated that he didn't need the money. And this was the reason that Warren Buffett was reaching out to him. It's going to give them extra leverage. It's going to give them extra security. Within 24 hours, they closed that deal. $5 billion was handed over to Bank of America. Warrants were handed over to Berkshire Hathaway. What does that look like? What is the difference between warrants versus options? Okay. So August 25th, 2011, Berkshire Hathaway invested $5 billion into Bank of America. In return, Berkshire Hathaway was given anywhere between 5% to 6% annual dividends, which equates to $300 million per year over the course of 10 years. That expiration date was 10 years out. The buy-in, the stock price that Berkshire Hathaway was able to lock in was $7.14. So at the time, and as you can see here, August 25th, the stock price closed at 765. And you'll see that right here. This is actually a chart that I've coded using Google Docs, Google Finance. So being that Berkshire Hathaway was able to lock in $5 billion investment at a share price of $7.14, this already gives them an unrealized profit of $357 million plus dollars. That is a win within 24 hours for Berkshire Hathaway, unrealized, meaning they didn't close the trade. They didn't pocket that $357 million. That $357 million profit is just in paper, unrealized. They were given 10 years to exercise this here. The expiration date, $7.14 is your strike price. This sounds a lot like options, right? But what makes this a warrant? What makes this a warrant is because this comes directly from Bank of America. This didn't come from another investor. If this came from another investor, that will be considered an options contract. An options contract also has to be priced at a fair market value. A warrant can be priced below a fair market value. An options contract has to be priced at a fair market value. This is huge for Berkshire Hathaway. This is huge for Bank of America because in turn, Bank of America, they get capital upfront that they can work with. Berkshire Hathaway, they get to lock in a lower price that they get to exercise for the next 10 years. Okay, this gave Berkshire Hathaway preferred stock and warrants. That preferred stock, of course, they get priority with any liquidations. It's like a liquidation preference. So anytime Bank of America has to liquidate with that preferred stock, the preferred shareholders, anybody that owns preferred stock, they get paid out first. You got preferred stock, and then you got common stock. Preferred gets paid out first. When Berkshire Hathaway exercised this in 2017, let's go to 2017, June 28th, so I can show you the closing price. So the closing price and the exercise price that Berkshire Hathaway took advantage of was $24.32. Let's remember, they invested $5 billion and they locked in $7.14. They closed it at $24.32 and they exercised that. That netted them, that gave them a 3-time ROI on their $5 billion investment. And at the time of June 29th, 2017, that netted them $20 billion. What a win for Berkshire Hathaway. Also a win for Bank of America, because at the same time, let's also think Bank of America, they generate net revenue. They're making money for their shareholders. So this is a win-win situation for both. Berkshire Hathaway netted 3 times in 6 years, 3 times the investment ROI. This is why he's the Oracle of Omaha. This is the difference between warrants. This is the difference between options. Options have to be priced at a fair market value. Warrants, they can be priced slightly lower than fair market value. This is a win-win. This is why I love that trade for Berkshire Hathaway. It gave them the right to buy 700 million shares at that price of $7.14. And they exercised that when the stock price hit $24.32. So this means that they exercised and they took possession of 700 million shares at $7.14 when the market was trading at $24.32. This not only made them the largest shareholder of Bank of America, but like I said, this gave them 3 times the return on their investment. Now, how can you mimic a warrant in the stock market? Remember, a warrant is just coming directly from that institution, but an options contract is going to be traded between investors. You can mimic that trade. Let's say if we were to go to Bank of America, we were to go to their options chain, right? Like I said, we have the options chain here. You can go out 802 days, going all the way out to January 17th. If you want to go out that far, you can. There isn't any volume there, so you may have a hard time getting filled. If we were to go out 165 days, you still have a hard time getting filled there. Let's try 46 days. Now, not a lot of volume for the strategy that we would like. But let's say, for instance, if we were to go and buy a call, because that's going to give us the right to buy shares at a certain price. Now, what they did was they locked in a warrant and it made it in the money. The reason it made it in the money is because they locked in a price that was lower than the market price. So if we were to actually mimic that warrant, we would have to go anywhere below the stock price closed today at $37. Anywhere below $37 is going to give us in the money. So if we were to buy The 36 put, the 35 put, the 34 put, that's going to give us in the money. That's going to give us the right to purchase 100 shares theoretically at $35 within the next 46 days. And we're hoping, of course, that the stock price is going to go above it's $2.97. The way options work, $35. We need the stock price to close above $37.97. Remember, we're paying a debit of $2.97. So we need that stock price to move at least $2.97 for us to at least break even to get that debit back. Anything above $37.97, we're golden, we're going to profit. This is how we can mimic that warrant. This is what I love about options. It gives us an opportunity, it puts us in a situation where we can mimic those warrants. Let me know what you think. This is amazing. This is why Berkshire Hathaway is Berkshire Hathaway. If you're interested in buying their stock, I would say look at B, Class B stock, because Class A stock is upwards of $490,000. Class B is a little bit more affordable. So it's about $290. It closed at $290 today. And it's going to give you less voting rights, but it's still a little bit more affordable. Let me know what you think. Thank you for your time. Like I said, my name is Ty. What do you like about Berkshire Hathaway? Peace.